Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. I mean, just look at this number, $705 million. That's what African startups pulled in during just the first quarter of 2026. We're not talking about a marginal bump here. That is a massive 26.5% year-over-year jump spread across 59 distinct deals. So the capital is definitely moving, but what's really fascinating, it's the underlying data-driven business mechanics of exactly where and how this capital is being deployed. To make sense of it all, we're going to systematically break down this intelligence report across 4 key acts. We'll start with the 2026 VC paradox, then dive into unlocking secondary hub alpha, move on to the climate tech supply chain edge, and finally unpack the repeatable flywheel framework. All right, Act 1, the 2026 VC paradox, contrasting traditional gridlock with cross-border agility. Let's set the baseline conflict in today's venture landscape, right? On one hand, you've got traditional domestic VC. They're practically paralyzed by extended exit timelines, just sitting on this massive pile of dry powder gridlock because they're absolutely terrified of severe macro volatility exposure. But on the other hand, you have these highly sophisticated diaspora business networks operating with high conviction agility. They are rapidly deploying capital. They're securing these incredible counter-cyclical returns, especially in AI and climate tech. They are actively capturing operational alpha while the legacy funds are just stuck. And this agility, it's completely backed up by the definitive market stabilization signals we tracked back in 2025. The African tech ecosystem saw total funding rebound to $4.1 billion. But you really have to look at the composition here. Equity stabilized at $2.4 billion, sure, but debt financing? Debt became an absolute engine for growth. It hit a record $1.6 billion, a 63% year-over-year surge. We're witnessing a very clear shift away from short-term, speculative portfolio inflows and toward disciplined, longer-term, project-based investments. Plus, Series A and B deal sizes grew by 21% and 12% respectively, which tells us institutional conviction is absolutely there for scalable companies with proven unit economics. Now, take a look at these net portfolio investment inflows. Volatile macroeconomic pressures are just a persistent reality in these markets. Think about it. When your capital is heavily concentrated in a few mega projects or just one geography, a sudden policy reversal or a massive foreign exchange shock can literally wipe out your returns overnight. It's brutal. So this completely necessitates a strategic pivot away from those concentrated bets, moving toward highly diversified, resilient African venture exposure. Which brings us to Act 2, unlocking secondary hub alpha through asymmetric information and talent verification. Historically, the Big Four, so that's Nigeria, Kenya, South Africa, and Egypt, they completely dominated, absorbing over 80% of all venture capital. But fast forward to our Q1 2026 data, participation has widened significantly across 14 different countries. We're seeing serious capital injections into non-traditional hubs. Senegal captured $32 million, and Ethiopia secured $15 million. Other maturing markets added another $40 million. So the traditional map, it is rapidly expanding. The crucial takeaway here is that this isn't some random geographic drift. It's a highly calculated portfolio strategy. By deliberately expanding this cross-border deal flow matrix, diaspora LPs and operators are drastically lowering their single market correlation risk. And at the exact same time, they're unlocking operational alpha in these secondary hubs, where competition is much lower, but the fundamental unit economics are actually improving. Ethiopia is a textbook example of this play in action. Deep cultural, educational, and regulatory ties give these diaspora-linked syndicates a massive asymmetric information advantage. They use it to navigate incredibly complex local environments. They're aligning their capital with major national blueprints, like the Digital Ethiopia 2030 vision, because they actually understand the granular, on-the-ground nuances of recent telecom and banking reforms. They can confidently deploy capital into a severely undertapped market of over 120 million people. These secondary hubs are literally being de-risked in real time. Take Senegal. They are actively leveraging their francophone market access and Atlantic port advantages to scale regional logistics and green tech. But the true secret weapon here? It's talent verification. Diaspora networks use deep-rooted cultural ties to verify local operators super early, which aggressively accelerates product-market fit. You have returning engineers bridging the gap between local founders and global LPs. The net result is that investor due diligence cycles shrink dramatically. These high-trust ecosystems are locking in operational alpha way before the mainstream VC firms even secure a seat at the table. Let's transition to Act 3, the climate tech supply chain edge, and how startups are slashing go-to-market friction. The sector breakdown of this capital surge tells an incredibly compelling story. Fintech remains a massive cornerstone, obviously, pulling in $769 million. But this cross-border deal flow is heavily financing explosive growth in infrastructure-focused sectors. Clean tech surged an unbelievable 186% to $550 million, and health tech skyrocketed by 232%. Investors aren't just funding consumer apps anymore. They're aggressively capitalizing on the continent's energy transition and deep structural needs. Startups in these specific hubs are generating true operational alpha by tapping into a newly matured infrastructure supply edge. It's fascinating. Widespread mobile money penetration is fundamentally driving down customer transaction costs. You've got dramatically improved broadband scaling digital service delivery across the board. And perhaps most crucially, operators are integrating directly with government digital public infrastructure, like Ethiopia's FIDA ID system, to aggressively slash go-to-market friction and completely cut out traditional operational overhead. This dynamic fundamentally transforms regional fragmentation into bankable, highly scalable pathways. As the African Economic Outlook 2026 clearly states, the quality of investment is now just as critical as the quantity. The entire focus has shifted toward building domestic capability and funding shared infrastructure. This ultimately anchors these startups in much higher value segments of the global economy. Bringing it all together, Act 4, the repeatable flywheel framework. This is the exact blueprint for staged capital. The absolute bedrock of this playbook is the geographic diversification matrix. It is extremely clinical and deliberate. Here's how they do it. Syndicates allocate a solid baseline of 60 to 70% of their capital into the big 4 core markets. That buys them baseline stability and exposure to mature tech. But they specifically carve out 30 to 40% to target secondary hubs. This barbell strategy effectively hedges core market macro volatility exposure while actively capturing higher growth convexity and serious operational alpha in emerging nodes like Senegal and Ethiopia. Based on that matrix, these operators execute a rigorous, repeatable 4-phase approach. First, mapping out that geographic diversification. Second, conducting highly specialized, on-the-ground operational due diligence. Third, engaging Pan-African syndicates to deploy staged capital, meaning they ensure these startups are adequately capitalized through every single follow-on growth cycle. And finally, proactively mapping M&A exit pathways, specifically tracking regional champions who are acquiring across borders. We really need to zoom in on that operational due diligence phase because honestly, that is where the magic happens. By focusing strictly on data-driven business mechanics, these high-trust ecosystems systematically de-risk their investments. They prioritize founding teams that have diaspora co-founders or advisors. They strictly demand clear, sustainable unit economics measured in local currency, not just in US dollars. They aggressively hunt for government or DFI co-investment signals. And they track customer acquisition costs meticulously against Big Four benchmarks to guarantee true capital efficiency. The window for securing this early advantage, it is closing rapidly. Looking at this Q1 2026 data, mainstream capital and traditional venture funds are officially on the clock. It begs the question, will traditional funds adapt to this cross-border deal flow matrix before the operational alpha in these secondary hubs is fully priced in? Capital has become highly commoditized, but the infrastructure to execute high-trust cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.